Welcome to the Deep Dive. Today we're taking a look at an idea that's been making waves, really. It's about adding infrastructure to your investment mix.
Yeah, this came up quite strongly from BlackRock CEO Larry Fink in his 2024 shareholder letter.
Exactly. So our plan today is to dig into that. We're using an article from the Motley Fool to kind of guide us. We want to understand why Fink's suggesting this and, more importantly, how you, the listener, might, think about it practically.
Right. How do you actually get exposure? What about potential yield? That sort of thing.
Okay, so let's start with the context. Fink talks about the traditional 60-40 portfolio.
The classic 60% stocks, 40% bonds. It's been, well, a bedrock for ages, hasn't it? It aims for that balance between, growth and safety. Fink acknowledges that history in his letter.
But he's proposing a change, a shift. What's the new model he's floating?
He suggests moving towards something like 50-30-20.
50-30-20. Okay, so 50% stocks, 30% bonds. It was 20%.
That's the interesting part. That 20% is suggested for things like infrastructure, private equity, maybe real estate.
So pulling back from stocks and bonds to make room for these other areas, why now? What's the thinking behind tweaking such a well-established rule?
Well, the argument really is that the investment world isn't static. Since the 60-40 rule became popular, whole new asset classes have emerged or become much more significant.
Ah, okay, so things have changed.
Exactly. Fink's point seems to be that a modern portfolio should probably reflect that wider range of opportunities. Think about it. Real estate through REITs is way more accessible now. Infrastructure is being seen as its own distinct class. Even private equity isn't just for the huge institutions anymore.
That makes sense. We do hear more about diversifying beyond just stocks and bonds. And the article points out getting into REITs, real estate investment trusts, that's actually fairly easy for most people, right?
Yeah, usually just like buying a stock through your broker.
But infrastructure, that sounds harder, less straightforward for an individual investor, maybe.
It can seem that way. And that brings up a key point. What is infrastructure when we talk about investing? The article defines it as basically large physical assets, the kind that generate pretty reliable cash flows over the long haul.
Okay, large physical assets, reliable cash flow. Not really speculative growth plays then.
Generally not. These are more foundational, essential services and structures.
Can you give us some concrete examples? What sort of things fall under this umbrella?
Sure. The article lists several good ones. Things like utilities, water, electricity, the basics. Also, transport networks like toll roads or shipping ports. Energy pipelines are another big one.
Okay, physical networks.
Right. And really relevant today, data infrastructure. So data storage centers, data transmission networks, all that stuff that powers our digital lives.
Got it. So obviously, you as an individual aren't going out to buy like a piece of a pipeline directly.
No, probably not practical.
So how do you get exposure? The article brings up a specific company, Brookfield Infrastructure. Tell us about them.
Right. So Brookfield Infrastructure tickers are BIP, and BIPC is presented as, well, almost a one-stop shop solution here. It's a way for individuals to get pretty diversified infrastructure exposure relatively easily.
Okay, BIP and BIPC. You mentioned two tickers, and the article notes different yields. One's around 6%, the other closer to 4.8%.
That's correct. BIP is the partnership structure, and that's the one with the roughly 6% distribution yield currently. BIPC is the corporate structure, yielding about 4.8%.
Okay, same underlying company, different structures, different yields. Why the difference? Is one better?
It's a really important distinction. They both represent ownership in the exact same pool of assets, so the underlying business is identical. The yield difference often comes down to, well, investor demand and accessibility. Some big institutional investors, like certain pension funds, sometimes have rules against holding partnership units like BIP.
Regulations or internal policies.
Exactly. So they might be restricted to buying the corporate shares, BIPC. This slightly smaller pool of potential buyers for BIPC can sometimes mean its price is a bit higher relative to distributions, hence the lower yield compared to BIP.
Interesting. So BIPC might be necessary for some institutions, while BIP might offer a higher current yield for those who can hold partnerships.
Precisely. It's something to consider based on your own situation and what your brokerage allows.
Okay, it clarifies the two tickers. Now, the article really emphasizes the track record for BIP, the partnership one. What's so special there?
Yeah, the consistency is pretty remarkable. Brookfield Infrastructure Partners, BIP, has raised its distribution payout every single year for the last 18 years.
18 years straight. Wow.
It is impressive. In the investing world, that kind of uninterrupted growth streak is quite notable. And it's not just small increases either. Over the past decade, the average annual increase has been around 7%.
7% average annual growth on top of that initial yield for 18 years running. Okay, that definitely paints a picture for income investors.
Absolutely. For anyone focusing on a steady, growing income stream, that's a very attractive history.
Beyond the yield and the growth, though, the article talks about diversification within Brookfield Infrastructure itself. Let's unpack that.
Right, because you're not just buying one toll road, you're buying into a whole portfolio. If you look at where their cash flow comes from, they use a metric called funds from operations, or FFO.
Okay, FFO.
About 26% of their FFO comes from utilities. Transportation assets like those toll roads, rail, ports made up the biggest slice at 41%. Then you got midstream energy, like oil and gas pipelines, at 21%, and data infrastructure at 12%.
So a mix across different types of essential infrastructure, that spreads the risk quite a bit.
It does, and it's not just diversified by sector, but also by geography.
So where are these assets located?
They're spread globally. The article mentions about 68% of FFO comes from the Americas North and South, then about 17% from Europe, and 15% from the Asia-Pacific region.
Okay, so you get sector diversification and geographic diversification. That's pretty comprehensive for a single holding.
Yeah, the article even suggests its diversification might rival some ETFs or mutual funds focused on the space. It's quite broad.
That's a key point. Now, there's another layer here. Brookfield Asset Management. How do they fit in?
That's the parent, or rather, the manager. Brookfield Infrastructure is managed by Brookfield Asset Management.
And they're a big player.
Oh, yeah, a huge global asset manager with deep expertise, especially in real assets like infrastructure. Their style is described as being a bit like private equity.
How so?
Well, they tend to actively manage the assets. They look for infrastructure they think is undervalued. They invest in improving it, upgrades, operational efficiencies, and then potentially they might sell it later if they get a good price and reinvest the money.
Okay, so it's not just passive ownership. They're actively trying to increase the value of these assets.
Exactly. They're very hands-on. It's about buying, improving, and potentially recycling capital into new opportunities.
So if you invest in Brookfield Infrastructure, you're kind of partnering with this big, experienced manager. You're benefiting from their expertise without having to find these deals yourselves.
That's a great way to put it. The article suggests it's like investing alongside a very sophisticated player in the infrastructure world. And thinking back to Larry Fink's 50-30-20, given Brookfield Asset Management's active private equity-like approach, investing in Brookfield Infrastructure could potentially tick both the infrastructure box and give you some exposure similar to that private equity style he mentioned.
That's an interesting angle. So it could potentially cover two bases of that suggested 20% allocation.
Potentially, yeah. It's an interesting thought.
Okay, so we've defined infrastructure. We've seen Fink's rationale for including it. And we've looked at Brookfield Infrastructure as one pretty concrete example. Let's bring it home for the listener. Why does this matter to you, someone maybe just managing your own retirement account or investment portfolio?
Well, I think the main point is that something like Brookfield Infrastructure offers a relatively simple way to get that infrastructure exposure Fink is talking about. It makes it accessible. You don't need to be an expert analyst on toll roads in Brazil,
Right. It bundles it up.
Exactly. And even if you're not completely sold on tearing up the 60-40 and going full 50-30-20,
right,
the characteristics of a company like this, the high yield, that long history of growing distributions, the global diversification across essential assets that can be attractive on its own merits.
Especially for income-focused investors, perhaps.
Definitely. If generating a reliable and potentially growing income stream is a priority for you, it's certainly worth a look, regardless of broader allocation theories.
Okay, so to quickly recap, Larry Fink suggests infrastructure deserves a place in modern portfolios, potentially shifting from the old 60-40. And the Motley Fool article highlights Brookfield Infrastructure as a practical way to gain that exposure, offering diversification, yield, and a strong distribution growth history.
That sums it up nicely. It's one tangible example of how you might act on that broader idea from Fink. And, that leads to maybe a final question for you to think about. Given how absolutely essential infrastructure is, the power, the water, the data networks, everything, it makes you wonder, What other areas may be currently overlooked or undervalued might offer similar long-term investment opportunities because they tap into those fundamental growing needs of modern society?
Hmm, that's a great question to ponder. What else is hiding in plain sight? Essential, but maybe not grabbing the headlines, something to definitely think about.